A little bit about financial and non-financial tools for performance measurement, balanced scorecard stuff. Then we'll talk about 3 different models that might be used to evaluate the success of a business unit. I'm sure all of you have heard of ROI. Some of you might have heard of residual income. And then EVA, economic value added, is the third, which is just a modified residual income. Then we'll talk about performance rewards. As we talked about many times, the bouncing ball model, if you do the right things for your employees for learning and growth, that will result in improved internal processes, which will result in improved customer performance, which would improve your bottom line. And so, as you judge your organization, you don't just want to judge on the bottom line, because that's short-term oriented. You also want to judge how well they're doing in these other 3 areas, because that will ensure long-term bottom line growth. So we just talked about responsibility centers. There are 4 kinds. In the last chapter, we talked about cost centers, revenue centers, and profit centers. Here, we'll talk about investment centers a little bit. How do you judge how well an organizational unit is doing in terms of investing the scarce capital of a firm for the firm's best interests? What you want to do as you look at investment centers is you'd like to make certain that you can compare how different centers are performing for the company, and you want to make sure that your senior management is motivated, incented, and rewarded appropriately. Some of the challenges with measuring investments, and these challenges are handled in EVA for sure. They're mainly the fact that investments are measured based upon, generally speaking, based upon historical costs, book value of the current assets, plus the net book value, which is the book value minus depreciation for long-lived assets. But this doesn't really reflect the true market value of those investments. And if you were to look at something like return on investment, where the investment is the denominator in the equation, we'll see that in a moment, the smaller your investment, the larger your return on investment, which would incent you to continue to work with old, fully depreciated equipment, because that reduces your denominator value. You'll see it in a second. So you need to be careful when you look at the investment level, particularly based upon book value. So you could do some other things. You could use gross book value, which is maybe a little bit better, which just takes the depreciation out of the equation. If you can, you can look at replacement costs. How much would it cost to replace the equipment with currently available equipment of similar service level and functionality? Or you might look at liquidation value. How much could you get in the open market for that equipment today? Alternatives to net book value for your long-lived assets. The book talks about all 4 of these. We're not going to focus on return on sales, so that's why it's grayed out. Let's first talk about return on investment, ROI. How many of you have heard of ROI? Everybody, please? Everybody? Okay. All it is your income over your investment. Another way of looking at it is income over revenues, times revenues over investment. And since in math you get to cross those out, it's still income over investment, which would say the return on investment is your return on sales times your turnover of inventory, your investment turnover. So return on sales is your profit margin. So that's the ability to make income off of the products you sell. Your asset turnover, which is your revenues over investment, is the ability to generate sales from your investments. If you were a cost leader, which of these two components can you really manage and focus on? Would you focus on? Why would you say that? Okay, so I wasn't thinking that, but yeah. So if you can control the expense component of income, then you get return on sales. Good. But you ever hear the phrase, make it up on volume? You're losing money, but we'll make it up on volume? That's what this is saying. Turn it over. How much business can you create? If you're a differentiator, you're looking to really maximize your profit margin, generally speaking, but I think you make a good point with managing costs. If you're a differentiator, you can focus on profit margin. If you're a cost leader, you focus on volume. That's how you make it. This way of breaking down the ROI is often called the DuPont method, in case you see that term. Right, exactly. So they don't have as high a profit margin, so in order to be profitable, volume. Kind of supermarkets, turnover, the inventory. Okay, so very simple one. This is not to be handed in. Calculate ROS, asset turnover, and return on investment for this very simple case. What's that? 1 for 20%. It's 100,000 over 500,000, which is 0.20. And what's your asset turnover? No, it's revenues over assets. So it's 500 over 250. So it's 2. Notice it talks about average asset value. You tend to take the middle value for a period. So your ROI would be 0.4 or 40%. That's your ROI in this case. So why do we use ROI? It's very popular. It's a number you hear all the time. It's a percent, so it gives you a sense. Is 40% a good ROI or a bad ROI? Seems pretty good, right? We have no knowledge about the company or the business or anything else. But without any knowledge, I'd say, yeah, 40% is an ROI you can live with. So it's a number that is easy conceptually to get a feel for. So, and it's very comparable to other ROIs. Now, ROI has some accounting issues associated with it. We talked about depreciation. Not only is the fact that your investments are depreciated a problem, but you can choose different depreciation approaches. What's the useful life? If you look at airline companies, they all have different useful lives for their planes. They depreciate them over a different period of time. Inventory measurement. Do you use FIFO or LIFO, since this is part of your assets? So your inventory levels might be different depending upon your accounting application. And then your capitalization policy, right? There's room for maneuvering. Is something an expense or is it an asset? Right? R&D is an expense if it's done internally. It's an asset if it's bought and turned into an intangible. Big deal for Pfizer. Now, how does that affect? If it's an expense, it reduces your profit. If it's an asset, it increases your investment. So it fundamentally changes the result, your capitalization policy. So ROI could result in goal incongruence, meaning you don't have the organization working to the best interest of the company. You might manage towards short-term profits to up your ROI in the short term if your people are being judged on ROI. You may avoid making investment in new assets if you're being judged on short-term ROI. So you need to be careful not to simply judge on the numbers. It's particularly difficult to work with in a service-based or a knowledge-based business where your physical assets are a small part of your overall business. It's really your knowledge and your employees that matter. And so therefore, ROI becomes a little bit less useful in that model. Sometimes companies will separate ROI and net present value. You've learned net present value in finance. So they'll use net present value for decision making. Should we which different alternative should we invest in, and ROI for evaluating performance. ROI also could disincent investments by the most profitable units. Let's say your company demands that you have 15% or better return on investment in order to do a new project. Your division is unusually profitable and gives 20 or 25%. You have an and you get paid upon your ROI. Your performance is based upon your ROI. You have an opportunity to do a project at 18%. It will bring down your unit's ROI because your other ROIs are higher, but it's still better than the rest of the company. You're disincented to do the right thing for the company. So ROI might disincent proper behavior. Here's an example. I think this is almost the example I just said. You're a division manager. Your bonus is based upon your ROI. The higher your ROI, the bigger your bonus. You're required to have an ROI of 15% on new investments. You produce a whopping 30%. And now you have an opportunity for a project for 25%. Still excellent, but not as good as your other return on investments. Would you do the project? Not with no other fact, you would not do the project because you're incented for personal best interest. So the advantages of ROI, Because it's a percent, you can compare large units and small units. It's all just percentage based. It's easy to understand. We all work in percentages pretty well. And it's widely used and therefore comfortable. We just talked about goal incongruence issues. And it's somewhat difficult to compare different units because ROI should be based upon risk, right? You should expect to have a higher ROI in a riskier business. You should be getting a risk premium. So simply comparing 40% versus 35% isn't enough. You need to understand the risks associated with various businesses. So an alternative to the ROI is something called the residual income. It's not a percent, it's a dollar amount. It's the actual income you get minus a cost that's placed on your investments. So it's the amount of your investment, so it's your actual income minus your investments times a required rate of return. So the required rate of the return is the imputed cost of the investment. Essentially says, for an investment of similar risk, how much money should I expect to get from an alternative investment? If you say you can get 20% elsewhere, you should not be doing a project that's going to get you 15%. So what you get is a dollar amount. If that dollar amount is less than zero, you shouldn't do your project, or you shouldn't be in that business. Because if your residual income is less than zero, that says you're not getting your full required rate of return on your investments. If it's greater than zero, you should do the project. Because you're adding to your residual income. The only thing I'd say here is a nice part of this is as you have different units with different risk profiles, you can have a different required rate of return. And therefore, you can judge different units based upon their various risk profiles. So that is an advantage of residual income. However, all of the accounting issues we saw before stay with residual income. Capitalization issues, inventory management, inventory issues, LIFO versus FIFO, depreciation issues. Okay, we have an example you get to do. You have an opportunity to invest $100,000 in a project that will return $25,000. Your required rate of return is 20%. And your ROI is 30% on your other businesses. What is the residual income and what is the ROI? And what would be your investment decision for each? What's that? ROI would be in a percent. Well, you're going to have a return of $25,000 on $100,000. What's the ROI? 25%. I didn't hear, sorry. So, would you do it based upon the fact that you normally get a 30%? You don't have enough information, but it would reduce your 30%. Let's see what the ROI would be. Your minimum rate of return is 20%, so your investment charge would be $20,000, 100% times 0.2. then your residual income would be $5,000. So if you were being judged on residual income, it's a positive number. You would invest based upon residual income. You would not necessarily invest based upon ROI. I'm not going to do that. So what are the advantages of ROI? It incents you to accept all projects that give you a return above your required rate of return. The other advantage is it's relatively easy to have different required rates of return on different units based upon their risk profiles. So therefore, you can differentiate by unit. The disadvantage, and this is a big one, is it would favor, if you have a scarce amount of money, it would favor larger units because the ROI, being a whole number, not a percent, will favor the bigger number. So a larger unit with a larger profit that may actually be a lower percentage with ROI would be favored because it's larger. And then this is just a complexity issue is, companies might have rate of returns, required rate of returns. Subunits, you need to have somebody figure that out. So, the EVA, economic value added, was created. Anybody here hear of EVA before? No. A consulting firm built a business around this. We're not going to get into this in super detail. Essentially what they did is they tried to manage the accounting problem. So they take your accounting numbers and have something like 100 different adjustments that they make to the accounting numbers to make them more economically based rather than accounting based. But it's really based upon the same concept as residual income, which is your income minus your required rate of return times your assets. So it's really focused on defining your economic profit, not your accounting profit. Stern Stewart is the consulting firm. I give you this little registered trademark here because it is, and which is why we won't talk about it too much because we don't need to sell Stern Stewart business. So they have over 160 adjustments that they make. And some example adjustments that I think come from your textbook. All three of these are short-term oriented. It's the rate of return this year. It's the residual income per year. So it's important as you look at units to compare across periods so that you maintain a long-term view. This is a good segue. We're talking about how do you judge a project or a unit. Well, you also need to judge managers because you want to give them promotions, you want to give them raises, you want to give them bonuses, as the case may be. It's important that you don't always just link the performance of a unit with the performance of the manager. A lot of non-controllable factors in the performance of a unit. How many of you would call yourself risk averse? You know what I mean by averse? You don't like to take undue risk. How many of you call yourself risk takers? How many of you have been skydiving? Got one skydiver? Bungee jumping. Paragliding, where you just put your arms out and hope that that thing works. People tend to be risk averse, no matter what this class says. People tend to be risk averse. You need to make sure that incentives incent the employee to act in the way the company wants to act. Companies tend to want to take more risk than an individual. So the risk profile of a company tends to be higher than the risk profile of any individual in that company. Because a company has a portfolio of risk, right? They know that some are going to work and some aren't going to work, but in the end they have a net expected value across all their risks that is manageable. The individual has their risk. It works or it doesn't work, and if it doesn't work, they're screwed. They don't have that same portfolio of risk. So a company would tend to want to take more overall risk, a well-run company, more overall risk than any individual in that company. And so you need to create incentives to align the individual's risk profile with the company's risk profile. I don't know. Sometimes employees, for whatever reason, because of risk, because they're not going to make their bonus anyway, so why work so hard? Sometimes take actions or exert less effort than their company would like them to. So you need to make sure that as you do performance analysis on an individual, you're doing it in such a way to get them in the right risk profile and get them to exert the effort that the company wants them to exert. You tend to have two different levels of performance evaluation. We're going to focus on management evaluation. Operational evaluation, you look at how well the employee is doing, kind of it's more short-term oriented. At the more upper management level or middle to upper management level, you really want to ensure that the manager is working towards the long-term interest of the company. And so you might see something called management by objectives. Have any of you been involved in a management by objectives organization? Where at the beginning of the year, you establish objectives. You go through that process saying, here are the things we're going to accomplish this year. And then, in your experience, at the end of the year, do you go back to it? You do. Operational control. Management control is more long-term oriented. So you establish objectives. Some will be financial. Some will be training-based, various things. And again, your goals in a management by objective organization are to motivate, incent, and reward. Employment contracts. Contracts could be written. Some companies actually have their employees sign annual written contracts. More often than not, they're verbal, they're implied contracts. Remembering that as human beings, we all are naturally inclined to work towards our selfish best interests. We all have a little bit of Ayn Rand in us, right? Remember no Ayn Rand? Where is it? Or am I dated? So contracts are a means of ensuring that the employee works towards the interests of the company. Employment contracts take on a principal-agent model. Have you talked about principal-agent models in other classes? You have. Okay. How many of you have heard of Alex Rodriguez, A-Rod? How many of you have heard of Scott Boras? A few. Scott Boras was the agent for Alex Rodriguez in his most recent contract negotiations with the New York Yankees. So this is a little bit of a dated thing because this is pre-steroid Alex Rodriguez. Okay, so A-Rod had his contract coming up. He had an agent who was negotiating that contract, Scott Boras, who is considered the best in the business. He gets more money for his employees than anyone, and he's a hard negotiator. Say again? No. No, he's the one. He's an agent. He didn't do that. We're not going to start that rumor here. So his contract came up with the Yankees, and A-Rod was negotiating a new contract, or Scott Boras was negotiating a new contract, and he was banging hard on the Yankees, and the Yankees threw up their hands and said, "No, we're okay. We're not gonna meet your terms. Go to the market." Scott Boras didn't realize that A-Rod wanted to go back to the Yankees. They had different information, and that A-Rod's primary goal was not to get maximum money. It was to get maximum money from the Yankees. So it ended up that A-Rod fired Scott Boras and signed a very lucrative contract. I don't think he's complaining. I think the Yankees are complaining right now. A very lucrative contract to stay with the Yankees. So that's the principal-agent model, and there are certain aspects of a principal-agent model. It's a complicated model. In the business setting, the employer is the principal, and the employee is the agent. The manager is the agent, the person being evaluated. In the real world, the agent is acting in a world of uncertainty, information asymmetry, and risk aversion. Uncertainty, information asymmetry, and risk aversion. So as the manager of a unit, uncertainty, it is what it sounds like. You don't know what's going to happen next year with the economy or anything else, or with your competitors. So you don't know whether you're going to make your numbers at the beginning of the year. That's uncertainty. Information asymmetry. This is really the biggest area of whining in a company that there is. It says that the agent, the employee, has different information than senior management. We're all dealing with different information, right? I know what I know, which is the details of my business. Senior management knows the direction of the firm, and it's not always the same. Maybe senior management knows what they're trying to spin off your division. And so they're telling you to do things that make no sense to you, but they can't tell you that they're trying to spin off your division. So therefore, you have different information. And so you'll be complaining about senior management. Why are they making me do this? Why are they making me do that? So that's information asymmetry. Different organizational units have different knowledge. And we talked about risk aversion as well. Risk aversion means that an individual tends to be more risk averse than the organization would want them to be. So this is just a visualization of the principal agent model. You have your external factors, your risk aversion. You make decisions. This is the individual. This is the agent. You make decisions. You create an effort. You have outcomes, results. Those results, management accounting figures out how you did, and then you're given a bonus based upon your results. That's just a visualization of how the principal agent model works. Okay, another problem. John Smith is the production manager of Elmo's Glue Company. You can only produce one of two solutions. Solution A is a space-age bonding formula that has a 15% probability of success. The success will get you a profit of $1 million and an 85% chance of just making $200,000. Or just kind of selling the old glue that you've always sold, making it a little bit better, and you have a 100% chance of making $310,000. John gets 20% of his department's profits. That's his bonus. John gets to choose. It's decentralized. Assume that John is more risk averse than Elmo's management. What would his choice be? Well, do the math. Did you do the math already? Huh? So you weren't listening to me. Everyone else do the math. Catch up. How many of you have heard of net expected value? That's the game here. What's the net expected value for the company? For B. 100% times 310,000 is 310,000, right? What's the net expected value of A? It's 0.15 times a million, and 0.85 times 200. Anybody do that math? 320,000. And now let's think about it from John's perspective. In the second solution, he gets 20% of 310, right? So $62,000 bonus. And in the first case, he either gets a $200,000 bonus at 15% or an 85% chance of a $40,000 bonus. Right? Is that right? Yeah. Assuming that John is risk averse, he'd probably go for this, to burn the hands worth two in the bush. Sure, he can get low probability, but he can get 200,000. The company probably would like to test this one out, assuming that they have other projects on the line. $10,000 is immaterial, but it's still higher. And if things work out, they have a new $1 million business. Right? So the example is a little bit skewed because of the numbers. You're right about that. But you're right, 10,000 is immaterial. But still, the company would probably want to go for this high-risk alternative. John may not be as, he has mortgage payments and other things that, he'd like to know his 60,000 is coming. You can. How many of you remember, this is directly your question, how many of you remember a game show called Deal or No Deal? It's exactly this, right? If in Deal or No Deal, as an individual, let's say there were 3 suitcases left, and you're the individual, and the 3 suitcases have $1 million, $5 and a penny. and they offer you $300,000, okay, which is below the net expected value of this, but they offer you $300,000. Compare that to a situation as an individual where you have $200,000, $300,000, or the numbers need to add up. It has to add up to $1 million. $250,000, $350,000, or $400,000, and they offer you $300,000. Okay, so the numbers add up here. They'd have just about the exact same net expected value, but as an individual who's risk averse, you'd be more likely to go for the $400,000 here, right? Because you have 2/3 of a chance to improve upon your $300,000 as an individual. As an individual, you'd probably grab the $300,000 here because you have 2/3 of a chance of being really unhappy, right? When you have a portfolio of risk, which is what the show has in Deal or No Deal, then you take the risk. When you're the individual dealing with this or this, you act differently. Does that make sense? So, these are the questions. One of the challenges of portfolio measurement is the concept of teams. Performance measurement, is the concept of teams, as you all have been learning in this class, and probably all your other classes as well. Some teams perform better. The teams perform better than any of the individuals can perform themselves. Other teams struggle to find their way. But generally speaking, companies are looking to get better results from teams than individuals can perform. And so your performance measurement needs to incent teamwork, proper team activities. Ultimately, you have to reward individuals, though. And so you need to have a way to base it on teamwork, potentially, and also on individual results. That's what we do in this class. Levers of control. So how do you control the way individuals act? There are diagnostic controls, boundary and belief controls, and interactive controls. Diagnostic controls are based upon quantifiable metrics, things you know well. Could be ROI, RI, and EVA. Could be customer satisfaction surveys and employment satisfaction surveys, 360 reviews, etc. So diagnostic controls are a way to get real substantive results. Boundary systems describe standards of behavior and what actions are off limits. I like to use the example from Goldman Sachs when I was there, and everyone who was a VP or above, we received a plexiglass thing, Bob, I still have it at home, that you put on your desk and you had to stare at every day, which said, of all your assets, I'm paraphrasing, of all your assets, reputation is the one that, when lost, can never be re-earned. And so that was what we had on our desk. So what they're telling you is it's okay to lose a little bit of money for the firm, but don't hide that fact. Don't do anything immoral, illegal, etc. Because they did not want their reputation tarnished for the long term. They could lose money, they couldn't lose reputation. So those would be belief systems, if you will, or boundary systems. Belief systems are very similar to boundary systems. And interactive control systems are just tools that you use to track how well you're doing on your strategic issues. Okay, compensation. The last thing we talk about in this class. Compensation is a mix of base salary, benefits, bonuses, stock options, things of that nature. You'd like to think that compensation is just based upon how well you did, but the reality is it's also based upon factors that are outside of your control. If the company does poorly because the economy was bad, your bonuses and your compensation is not going to do as well. It's outside of your control, but that's just the reality of the business world. So you try to make it as based on as controllable factors as you can, but it can't all be controllable based, and you need to balance short-term and long-term incentives. Compensation is based upon, to some degree, where you are in your business life cycle. So if you have a new product that's being introduced, not a whole lot of sales associated with that product, you need to incent high-quality people into the company so that they will help to create a product. You have to pay them a high salary to do that because you don't have revenues, you don't have, you can't base bonuses off of something like that. So a new startup kind of business is going to tend to have high salaries, low bonuses, and low benefits. When you're in the growth phase, you want your employees to really be driven towards fueling that growth. And as such, the salary would be a relatively small part of your business, of your pay structure, and bonuses and benefits would be higher. As you reach maturity, and essentially you want to keep some good people so you can keep the cash cow going, you would be competitive across all three. And when you're in a declining business that you just want to milk until it's done, you have bonuses are going to be tough. You can't have in a shrinking business it's tough to have bonuses, so you'll have to go back to a high salary model again for those people who you want to keep around to get as much out of the business as you can. I'm sorry, second. Yeah, it applies to everybody. Now, I think what's a bit this is what's a bit untrue here is for product introduction, the people who are starting the company are probably owning a percentage of the company. Someone has to have that initial ownership. But the pay is not necessarily bonus-based. So compensation, you want it to be as much as possible based upon factors that are controllable. At Goldman Sachs, where bonuses were a big part of salary and still is, it would always whipsaw back and forth between the fixed income division and the equity division. And that had nothing to do with who was doing a better job. It had everything to do with, in a booming stock market, the equities division did really well. And when the stock market was a little weaker, the fixed income division did very well. And that was not in the control of the individual. You just kind of got used to that model over time. So let's focus on bonuses. Bonuses are based upon three factors. The basis of the compensation, which could be stock price, how well your unit performed, how well you did against a balanced scorecard. The compensation pool, which is how much money is available to split out for bonuses. That's where the economy comes into play. And then the payment option. How will those bonuses be paid? The basis. You have the stock price as a basis, far less controllable by the individual, but clearly aligned with the shareholder value. How well your unit performed, aligned with the individual. Might be short-term oriented if you're not careful. And the balanced scorecard, if done right, very much aligned with the individual and potentially long-term oriented. So this pretty much says that. Stock price is a great motivator. A plus sign means it's good, because it's aligned with shareholders. But how well your unit did and balanced scorecard are also aligned and motivational. The challenge with balanced scorecard is sometimes it's hard to get the numbers. I mean, you guys did it, and you couldn't possibly get the numbers, even inside of a company. Some of these metrics are hard to deliver on because they're just not recorded on an accounting basis. The pool, the bonus pool. Generally speaking, bonuses are paid out of two pools. A unit pool, which is your specific strategic business unit is given a certain amount of money to split out, and then also a firm-wide pool. The goal here is to incent your unit to do well and to incent teamwork across units. So you get money from the firm-wide pool based on how well you played with the rest of the organization. Of course, you want to make sure that your bonus plans are well designed. This has a problem because if you're up here, you have no incentive to do any more work. If you're down here and it's December 15th, you have no incentive to do any more work. So you want to make sure that you have a plan that incents optimal results. Bonus payment, the third of the three factors. You have a current bonus. This is the old way of doing it. Still done to some degree, but much, much less. At the end of every year, you get a bonus check. Problem with that is you get the bonus check and then you leave. That was the game. A lot more, at least on Wall Street, a lot more deferred bonuses now. That your bonus is tied, you get a piece of it this year and a piece next year and a piece the year after that, and that's constantly happening. And it's that concept called a golden handcuff. Keeps you tied to the company, because if you leave, you're going to lose the deferred portion of your bonus. Stock options confers the right to purchase stock in the future at a predetermined price. So instead of giving an outright bonus of stock, let's say, you're giving them the right to purchase it at a price, which incents particularly senior management to do everything they can to raise the value of the stock, because of when that day comes around, when you're supposed to, or that window of days comes around where you're allowed to purchase the stock. If the stock is underwater, meaning it's below your price, you're not going to buy it. So you want to make sure the stock is higher, because you can buy it and then turn around and sell it immediately, and that difference becomes instant profit for you. Performance shares are, instead of stock options, you're simply granted stock in the long haul. So you don't have to be above some kind of a strike price. And that's it. That's all we got. Okay, thank you guys. Let me give you all your